Welcome to the CFA Level 1 series of questions and answer videos. We covered 12 questions in 3 videos so far. We will start today with question number 13, and this is the video number 4. So let us start. As I said, we will start with the question number 13. A company currently has a debt-to-equity ratio of 1.25. Common shareholders' equity is $4 million, consisting of 1.5 million shares outstanding with a current price of $28 per share. Part of the company's debt currently outstanding is $1 million of convertible bonds. Each $1,000 par value bond can be converted into 50 common shares at any time during the next 3 years. The coupon rate on the bond is 6%, with interest paid annually. If all convertible bonds are converted, the company's debt-to-capital ratio is closest to, and then we will get some answers. Let us see what is written here and what is meant by that. Okay, now the company has $1 billion of bonds that are convertible anytime soon, but he assumed that it is being converted. This will reduce the debt by $1 million and simultaneously increase the equity by the same amount. So the equity will go from 4 million to 5 million. That is very important. But before going into the calculation and the answer, I want to remind every student that be careful about the questions. The question here, the company's debt-to-capital ratio. The question about debt-to-capital. Why did the question start with debt-to-equity ratio? Let us not confuse the two terms. Debt-to-equity is totally different than debt-to-capital. This relates debt to the total value of the equity. Here, debt is related to the whole capital in form of debt plus equity as well. So be careful when you read the questions. These are the answer given. Let us see few calculation. Number of new shares will be $1,000. Divide each 1,000 will give 1 shares into 50, because each 1,000 will be given 50 common new shares. So the company will issue new 50,000 shares, but the equity will increase by the same amount because we debit the convertible bond to make them zero, and we will credit the equity with so many items, but this is not accounting. What I want to say here, the new equity will be the 4 million we have plus the 1 million redeemed convertible bonds. So the new equity will be 5 million. Current debt is 4 million times 1.25, because debt over equity equal 1.25. I have the equity of 4 million. I can find out the current debt 5 million by multiplying the equity by 1.25 times, which is the debt to equity ratio. This is the current debt. But the new debt will be 5 million minus the redeemed one. Now we cancel this one. So the new debt will be 4 million. Now I have all the figure to calculate the debt to equity ratio. I will divide the new debt by the new equity plus the debt, both of them. This is the new debt, divide capital, that is equity, the new figure, and the 4 million, the new debt. This is debt plus equity, which is the capital. This gives an answer of 44.4, which gives the answer number 8. Let us move on to question number 14. A company has just issued 5 million of mandatory redeemable preferred shares. What does that mean, mandatory? That means the company has to pay this. There is a present obligation to pay this amount in the future by redeeming these preferred shares. As per the US GAAP, such transaction will be recorded as liability and not equity, because although it is preferred shares and it used to be part of the equity, but the US GAAP, since it is mandatory redeemable, that the company has a present obligation to repay this amount to the current preferred shareholders. So it is a liability with a par value of $100 and pays 7% dividend. The issue mature in 5 years. Which of the following statement is least likely correct? The companies A, B, C. So the first answer is A, debt to total capital, that is debt and equity, ratio will improve. Let us skip this and look for B. Interest coverage ratio will deteriorate and preferred shareholder will rank below debt holders should the company file for bankruptcy. These are the three answers. Let us see how this will be affected. Debt to total equity. If we are issuing new debt, which is preferred shares, as I just mentioned, it will be treated as per the US GAAP as debt. So debt will increase, and also within the capital, there will be increase. So both the debt will increase and the total capital will increase. But when you divide both of them, you will find that the ratio increase. That means it deteriorates. It will not improve. It will deteriorate. Do any calculation, for example, from 2 debt became 3, and total capital from 5 will become 6, and do some calculation, you will find out that it will change higher. Interest coverage ratio will deteriorate, definitely, because how do we cover the interest ratio? How to calculate it? With this calculation, interest cost divide profit before interest. So profit before interest will not be affected by the new debt, but the interest cost will increase because dividend paid to mandatory redeemable preferred is considered as interest. So interest will increase and it will deteriorate the coverage ratio. Preferred shareholder always by law, not by accounting standard. Although here, as per the standard, we treat it as a debt, but in law, still it is equity and debt holder will come first. So the C is right and B is right. So this is the least correct. That is the wrong answer, which is the required answer. Number 15, a company's 100 par perpetual preferred stock has a dividend rate of 7%. So the company will pay exactly $7 for each $100 and the required rate of return of 11%. That means I, as investor trying to buy this perpetual preferred stock, my required rate of return 11. I will come to this. Let us finish the question. The company's earnings are expected to grow at a constant rate of 3% per year. If the market price per share for the preferred stock is $75, the preferred stock is most appropriately described as 3 answers. Is it overvalued or undervalued? And undervalued is different number. These are the questions. To answer this, we need to see the fair value of the preferred stock. If you remember the golden rule I used to mention in all the videos in this series, the playlist I have on the CFA Level 1, which is 15 videos, I always call this formula a golden rule, that the value of preferred stock or normal stock, ordinary shares, or even a company for merger and acquisition or valuing any asset, you will see the cash divided by the rate of return. The cash I receive is $7 and the rate of return I require is 11%. So by dividing the cash of 7 by the 11% rate of return, I will get the fair value of the preferred stock. $7 divided 11% will give, this is the fair value. But the question says that it is selling for 75. It seems that it is overvalued. This is a fair value and this is the current market price. The difference between the two will give the overvaluation 11.36, and this is the right answer. So as I mentioned, it is the least answer in the previous questions. Which of the following statements regarding Marquis' efficient frontier is least likely to be correct? The optimal portfolio for any investor an investor is the portfolio that lies on the efficient frontier and provide her with the greatest level of utility. B, an investor is found at, that means the optimal portfolio for investor is found at the point of tangency between the efficient frontier and an investor highest utility curve. So it is either on the tangency at the efficient frontier or lies on the efficient frontier. These both are the efficient frontier. Yes, this is the efficient portfolio. If you want to construct an efficient portfolio, that portfolio has to be on the efficient frontier. It's a curve. Any point in that curve will be efficient given the risk appetite of the investor. Any point, let me repeat this, any point within that frontier, that curve, is efficient. And also if it is on the line tangent to that frontier. So these both answers are correct, and we are looking for the least likely to be correct. That means it should most probably be C. Let us read it. The optimal portfolio for a more risk-aware investor will lie inside the efficient frontier, but will lie outside the efficient frontier for a less risk-averse investor. Whether I'm a risk taker or a risk averse, both this will be wrong. Nothing will be efficient within the outside or inside the curve. So it has to be whether you have high risk appetite or low risk appetite, both you have to construct a portfolio that lies within that frontier. The risk factor will decide how much return you should expect. The higher the risk, if you are risk averse, you will take low risk, so you should expect lower return. If we draw that curve, you will be at the lower side of the curve. But if you are less risk averse, that means you are a risk taker, you will expect more return and you will be on the upper side of the frontier and to the left, because you are taking more risk and you will get expected more return. This is wrong. 17. A primary motivation for investment in commodities is most likely that means why. In simple terms, why do we invest in commodities? What motivates us? Let us see the answers. A positive correlation of commodities with unexpected inflation. That means commodities tend to go higher with higher inflation and will go down with lower inflation. That means it mimics the inflation. It goes hand in hand because there is a positive correlation. B. Positive correlation of commodities with the stock and bond investment. There is no correlation between these three items. Positive volatility of commodity relative to stock bond investment. As I just mentioned, the correlation is very weak normally between commodities and stock and bonds and all other forms of investment. So what motivates me to invest in commodities is that commodities tend to go up. So if there is a high inflation, bond and investment, stock and bonds will go down because interest is likely to go up, and hence the required rate of return will be higher and the value of stock and bonds will be lower. So the commodity will also be affected. So The positive correlation is with the inflation. The higher the inflation, the commodity will compensate me for that inflation by higher prices because there is a positive correlation. A is the right answer. I think with this we come to the end of the video. Please do subscribe to the channel so that you get the full list of question and answers.